So great. So now you've finished filling out your loan application, and let's talk about what the actual loan offer might look like. Specifically with regards to a term loan, there's a few sort of key components to think about. Certainly it's the amount that you've been approved for. So in our case for Haber & Company, we had applied for $100,000 to open our new office. We submitted that application to Bond Street, who then got back to us with an approval and a specific interest rate. So interest is essentially the cost of borrowing that capital and how much, in addition to that $100,000, you're going to have to repay over the life of the loan. One of the key data points in any loan offer you should understand is what the repayment period and repayment process looks like. So with a term loan, hopefully that's at least a year long, can often be up to 5, in some cases 10 years long if you're getting a traditional bank or SBA loan. In our case, it's biweekly, and in many cases it's on a monthly basis. So knowing what that biweekly payment looks like and being able to anticipate that cash flow going forward is really important. With regards to the interest rate, interest is one piece of the true cost of the loan. Typically, lenders have an additional fee or cost associated with borrowing. So in Bond Street's case, but it's consistent with most banks and others, there's an upfront fee that we charge when we approve a loan. In our case, it's a flat 3%. And so if it's a $100,000 loan, we're typically sending $97,000 upfront, and you're repaying that $110,000 throughout the life of the loan. That additional fee adjusts the interest rate into something called an APR. And so an APR is basically the common metric to clearly benchmark that type of loan offer to any other type of loan product you might see. And so you might be familiar with APR with regards to a credit card. Typically APRs for credit cards are 25% to 30% interest. You want to make sure whenever you're borrowing that you're getting that number from your lender. We are always incredibly transparent with the true cost of the loan and give full detail for what that looks like. Not every lender does this. And so it's really important whenever you're considering applying to ask for that specific number so you can fully understand the true cost of the loan for your business. Another important thing to understand is the terms or covenants of the loan. And as I described earlier in the process, there's different types of loan products that require different levels of security. Typically, the lower the interest rate, the more security that you need for the loan. And so in Bond Street's case, we require both the owners of the business as well as the business assets to be pledged against the loan. And this is true of any typical traditional bank loan product. Credit card financing isn't secured by your personal assets, and therefore the rates are significantly higher. When you get a mortgage, that loan is secured by your home, or your in a commercial mortgage by your business real estate. So understanding that security is really important when understanding the terms and covenants of the loan. Lenders in some cases require that you inform them whenever you're considering taking on additional financing, whether it be equity or debt financing, because they want to understand how that new financing is going to impact the expected profitability of that business. So if we've looked at your financials and approved you for $100,000, it's because we believe that that investment in your business, it's going to pay out more than the interest rate that we're lending you, right? And that's the calculus you need to understand for yourself is, I believe that borrowing that $100,000 is going to pay back more than the $10,000 that I'm paying back over the period. If you're borrowing additional financing, in that 1 to 3 year process, that can impact your profitability. And so your lender is going to want to know that information. And on the equity side, if you're selling a big part of the business and there's a new stakeholder in your company, that person should also be informed of what existing debt exists and what their obligation to that might look like. So the nice thing about a term loan is that you know exactly what your repayment schedule will look like throughout the life of the loan. It's the same, in our case, biweekly payments, over that 1 to 3 year period. So you can forecast, how much cash you're going to need to have on hand, or what the future profitability of that investment should look like in order to pay back the loan. There are other loan products that are a little bit more difficult to sort of clearly calculate the true cost. And so, you should be careful of this and try to get clear visibility in evaluating those options. So, this is true of products like merchant cash advance. It's often true of factoring or invoice financing that we described. Specifically with merchant cash advance, it's hard to know you don't know the time it's going to take you to pay off the loan, because they're taking a fixed percentage of your daily revenue. So meaning, if you're investing in your company and you're doing incredibly well, you're going to pay back that loan much, much faster. And so that fee that we described earlier is going to have a bigger impact on your APR, which is the annual percentage rate, the annual cost of the loan. There are some lenders who purposefully hide that APR because it's a very high number. And so it's especially true in MCAs, which are merchant cash advance, where the rates, start at 40, 50%, in some cases go to triple digits, over 100% interest. So, be very careful when looking at and evaluating, your different options. In a term loans case and in Bond Street specifically, our rates run anywhere from 6% to sort of the high teens, low 20s. Our average rate today is around 12%. So whenever you're considering raising any type of financing, and specifically debt financing, it's a pretty considered transaction. So you should make sure to talk to your lender and ask any questions that you might have.